Hi, I'm Mike Gassewitz, CEO of TriCert Financial Group. Welcome to another episode of InFocus. Today we're going to look at the investment overview of the third quarter and also talk about the recent U.S. election and Trump's win. Joining me today is Joel Baker, our Chief Investment Strategist. Welcome, Joel.
Hi, Mike. Thanks for having me.
Yeah, great to have you on. So, as we were pulling this together, obviously we felt we'd be remiss not to talk about Trump's election victory. Obviously, you've all heard about this and lots of opinions and the like. So we wanted to talk about it as well. So why don't we start there? At the time that we're recording this, the Republicans have gains in the Senate. And I'd still say, as last I've heard, still possibly the House. I think that's still up for grabs. But, politics aside, let's talk about, from a U.S. policy perspective, a fiscal policy and, implications to the U.S. economy and obviously the linkages to the Canadian economy. What are your thoughts here, Joel?
Yeah, those are all great points, Mike. And as you just mentioned, a lot of news circling around, a lot of reading to be done, a lot of information to decipher. So yeah, big topic for sure. But, I think we all know that, of the two candidates, Mr. Trump is much more what I would call market friendly. And it really just boils down to his, I guess you'd call it pro-growth policies. And so by that, we're referring to the lowering of taxes, is what we're reading about, decreased regulation, which in all honesty might be a good thing. Larger deficits, that's definitely in the headlines. So, and one could sort of maybe argue that could lead to higher inflation again, but again, that's yet to be seen on some of the details. But probably the big one, Mike, is, as we all know, the Trump administration really promotes protectionism. So instantly we want to know, what does that mean to us in terms of increased tariffs, the effect on us as Canadians. Obviously, how does that affect our Canadian companies, doing business with their American counterparts and really the rest of the world? What does that mean exactly? So a lot of details to be determined here. From our research so far, it appears Canada is not really on any sort of immediate list. But I must admit, Mike, any trade partner is going to be concerned. No doubt about it. They're going to be watching this very closely with regards to policy changes and what does that mean exactly. So, a lot of big ticket items that are going to be big ones for sure, but a little bit early yet to decipher what does that mean exactly as far as Canadians in our core picks and Canada companies.
Right. And, one good thing, politics aside, whatever side of the spectrum each listener is on, I think the good news is it was a decisive victory. Could have gone
Yes.
either, and again, back to what the market looks for, it's uncertainty that really causes a lot of volatility. But the good news is this was he was a clear-cut winner despite, what people may be thinking one way or the other. So I would say that was definitely good news. We're seeing how the markets have reacted. They were pretty positive in terms of the outcome. Do you think that was more around just this uncertainty being removed and things a little more certain, or there was this talk beforehand about the Trump trade? And any thoughts on that?
I think it's both, Mike, to be honest. So yeah, let's just back up a little bit. When we chatted last time, we were having the call, we were talking about expecting volatility into the final quarter. And I would say that that's, somewhat normal for this time of year. But being 2024, it's seen strong performance across all asset classes. Really, some profit taking was expected. But I must admit, we weren't expecting all the volatility in, call it, 48 hours. So there was a lot of volatility here in a very short time frame. The last time we saw Mr. Trump win the election, markets were down literally overnight. It really was that sort of simple. And one could easily argue it was up and to the right ever since then. So markets were really strong, as you mentioned. I think, to use your phrase, Mike, politics and personal profiles aside, markets seem to like a businessman sailing the ship. Like they really seem to like that. They favor that. In terms of strategy, though, I'd say there's no real knee-jerk reactions, Mike. We're still buying diversified companies, the same kinds of larger cap, what we would call high-quality companies. We'll be going down our holdings to see if there's any sort of trade jeopardy, to use that phrase. But I must admit, we come through on a regular basis, all of our core picks, regardless of the politics. So I think that's sort of a given that we're on top of the companies as best we can from that regard. I always like to look back. So just to take a step aside, when Donald Trump won the first time around, the next 12 months had the S&P return 22%. So pretty strong numbers. And if you sort of drill down, the top three sectors were technology, financials, and materials. So those three actually outperformed the broader market, but it came in fourth at 22%. So very, very strong numbers to your point. But back to your original question, I would say there's no real instant worry on the portfolios. It's pretty early yet to make any sort of a rash decision. But obviously, once we know more about those sorts of details, Mike, in terms of policies, we can do a much deeper dive on any sort of potential adjustments, whether that be a certain sector adjustment or a specific name or asset allocation, just anything like that as far as details. I must admit, though, one item to point out is that we're not going to make any sort of rash decision on potential bets on U.S. policy by risking investors' capital. I know that sounds maybe like a given, but if there's one thing we did learn last time, Mike, from Mr. Trump's victory was that it's not to expect the unexpected when it comes to headline news. So again, exactly. Status quo with returns to strategy, I would say, but once we know some more details, there'll be some tweaking for sure. It's just a little bit early yet to determine what that is today, but.
Yeah. And surprise, surprise, not everything that's said during an election campaign actually makes it to policy.
Correct.
A little sarcasm there. So I think it's only prudent to say, well, look, and one of the advantages of the Q-sect approach, we're in quality companies. And as you said, maybe some adjustments may be necessary, but I think it's way too soon to actually kind of predict on that front.
Yeah, and to that point, Mike, even to change any sort of a political sort of decision, policy adjustments take a long time.
Right.
So just the fact that they're talking about it, it could be a long time before we see any sort of printed action. So.
Excellent. Good stuff. Thanks. Thanks for that insight, Joel. So let's get into see what we saw in the last quarter with respect to macroeconomic data and the trends we saw. Let's, obviously, and arguably what was first and forefront on the U.S. election was inflation and the impacts of that. So let's start there. The consumer price index. Talk about what we saw and comparing Canada and the U.S.
Yeah, inflation's a biggie for sure. So yeah, both continue to trend downwards, which is a great sign. The U.S. was running at about 2.4%, Mike. We were slightly lower ours came in at 1.6%. And at the end of the day, it really did support the Bank of Canada moving ahead of the Federal Reserve in terms of cutting rates. So both trending down, both are sort of within the central bank's bands, if you will. So I think we're all good on that front for sure.
So let's turn to then GDP from a growth perspective in the economy.
Yeah, another good one for sure, Mike. So that one's a little bit of a yo-yo. So regardless of the details, if you sort of look at it from hot off the press, if you will, the U.S. numbers just came in and they're running about 2.8%. So they're slightly ahead of us here in Canada, which we're running about 2.1%. And actually, we just came in last month right at 0.0%. So again, another, I guess you'd call it a supporting metric for the Bank of Canada to move ahead of the Federal Reserve. We just needed that little bit of a stimulus to kind of get the economy boosted a wee bit. So.
Okay. So let's look at some forward indicators on the economic front. So, I know we've had several calls within the organization looking at things like the residential building employment, maybe starting there, maybe talk a little bit about that metric and what we're seeing.
Sure. So yeah, maybe I could just back up one step, Mike. So you're hitting on a very good one for sure. We've always sort of tried to look at the economic indicators, especially in terms of looking at and predicting recession. So if we were to sort of look at the economic data and study that, I'll call it a bucket of information and set that aside. Then if we look at the stock market performance in terms of a different bucket of information and set that one aside, it could easily be argued that the indicators don't support a stock market that's bouncing off all-time highs. It really doesn't jive if you look at it, that simply. Generally speaking, the leading indicators, Mike, are still pointing to weakness in the economy. The good news is we're trending better. But quite frankly, the U.S. continues to be stronger than we are from a economic rebound or a strength of economy perspective. So, the ones you mentioned there are certainly good ones. Residential building employment, that's hanging in stronger than durable goods manufacturing. And the two, if you sort of look at it from a period of, we just went through a rising interest rate environment, you'd think the two would be moving in tandem, but they're not. One is hanging in better than the other. And so it just goes to show that it's another example of it being harder to decipher the economic tidbits in terms of determining the performance of the stock market. It really is a unique situation where from an economic indicators, it doesn't really support the valuations in the market that we're seeing.
Right. Interesting. So speaking of interest rates, and you already touched upon that when we looked at some of the GDP numbers, talk about what we're seeing, Canada, US, shape of the yield curve,
Yep, that's a great one, Mike. So there's definitely a good one that has this very strong indicator of indicating a recession. I'll just sort of say it that way, the yield curve. So an inverted yield curve, as you may recall from last time we chatted, is a very strong indicator of an economic recession. And so to kind of put it in perspective, the yield curve does remain inverted, but very, very slightly, Mike. Things are flattening out. In fact, one could, almost pick up time frame within the yield curve and say that the inversion is in fact behind us.
Right.
But for the most part, it is a flat curve. Just kind of give you an example. A common metric is to compare the 2 and the 10-year yield curve and look at that perspective. That would produce a flat result. Whereas last time we chatted, it was truly inverted. To kind of put it in perspective, Mike, the yields are all kind of lingering in that, say, 3 to 3.5% band. So they're all very, very close, but one could argue that the inversion is tipping out into a normal yield curve, albeit very slowly.
Okay. And let's talk about, back to interest rates and just understanding the spreads between corporate debt versus government.
Mm-hmm. Yeah, another good one. So corporate yields remain higher than governments. Particularly as we move out across a typical bond ladder. And to make it simple, Mike, government bonds are very, very flat. They're all about 3%, depending on which term you look at. They're all kind of coming in at that 3%. And if you move out across our typical bond ladder, or even beyond 5 years, the corporate universe does tend to go up and to the right. So we're seeing that expansion, ever so slightly as we move out the curve in terms of increasing that spread between the two. So put simply, the government world is pretty much as flat as you can get it. The corporate world is certainly starting to increase.
Okay. Let's talk about, from a business perspective, earnings. What did we see reporting from let's say the Mag 7, that's the Magnificent 7 that we've talked about before. Let's compare their earnings versus the rest of the S&P 500.
Yeah, that's a great one. So busy time of year for our research folks. I know the team's, busy looking at the earnings as they're coming out. We still have a ways to go to digest these, but so far, Mike, the companies have reported about 75% of them are beating the earnings estimates. Drilling down, that's by an average of about 6%. Again, I'm using rounded numbers there. But the little bit of a concern there is that that's below both the 5 and the 10-year averages. So that's something to raise the radar a little bit, that earnings are still growing, but it's sort of at a lesser rate. Probably the easiest observation, Mike, is when we look at that, the market's clearly rewarding positive earnings surprises with better than average performance and punishing those that miss by more than average selling side, so downward pressure. And that goes back to our volatility comments of there a minute ago. And really it's a case we usually see this in a world where elevated valuations exist. And some call that a price per perfection type of a market environment. So if someone misses their earnings estimates or their guidance, they really get punished from a market perspective. So we're starting to see that in the volatility concerns. I'm sure we've seen some headline items that examples come to mind of that as we read it. And it really is a case where they're not missing their current numbers, so the market's punishing them. A bit of good news here is that looking forward, consensus estimates are leaning towards higher earnings for both 2024 and 2025. So again, the trend continues to go up and to the right. So that's a very good vote of confidence, I think, in corporate world, as you mentioned. But back to your original question, though, there definitely is a broadening out of earnings. They're not just in 7 names anymore. The remaining 493 companies are seeing an improvement in their forecast both this year and next. So that's very, very important, I think, in terms of the market being a little bit more well-rounded. It's not just 7 companies representing the entire S&P.
Yeah, that is good news. So let's bring it to dividends. Any sector standouts that you want to highlight?
The dividends are very key, as you all know. It's a very reliable source of returns, especially through the volatile markets. I'm sure viewers are seeing their equity names making headlines in terms of raising their dividends, and that's a very, very bullish sign, Mike. So, in fact, if we sort of drill down in our core pick universe, the companies have raised their dividends on average 8% annually over the last 5 years. And if we expand that to a 10-year time frame, the number increases to 9%. So sort of drilling down, longer term, the sectors that are leading the charge in that are the financial sector, the consumer sector and the resource sector. So those are the 3 that are really, driving those rising dividends, but it's a very, very bullish sign when the companies are doing that.
Excellent. So let's turn to the market, the reactions, in particular, the S&P 500 and the TSX.
Mm-hmm.
Look, if we're looking forward, is the market still cheap or is it expensive? Like, any thoughts on that?
Yeah, great question, Mike. So we've seen a bit of a shift in the markets here. And it's mainly investors' attention to those beaten up dividend payers that we spoke about last call. Despite that, I'd say that the markets aren't cheap. The market's trading at about 21.5 times, and that's from a price to earnings ratio. If we look at the Mag 7 and remove those, it drops to about 18.5 times, Mike. And if we compare that to long-term averages, the number is 16 times. So it's not really a kind of head for the exits as far as any sort of a valuation drift, but I certainly wouldn't say that they're inexpensive. They're not cheap, to use that phrase.
Yeah. So in that context, then, are there any sectors that have interest to us from a valuation perspective?
That's a great question. So where do we go from here? So really there's three things that jump out to me as I sort of look at these. One is buying sectors that aren't expensive compared to their historic averages. That's something that we want to keep on top of. Looking at those opportunities would be a second one. So we mentioned a second ago, if there's any sort of beaten up names that don't hit their earnings estimates or their forward guidance, they do get sort of punished. So is there opportunities to buy some of these quality companies that just maybe have an off quarter? And the third point is really just looking outside the U.S., Mike. So if we look at, Canada and even international markets, valuations aren't quite as demanding as they are in the U.S. market. And as a result, they're trading at cheaper multiples. So a combination of those three really, defines our radar in terms of the corporate universe of new names or new additions.
Right. Okay. Makes sense. Joel, thanks for this.
You're welcome.
As always, folks, if you have any questions about what you heard, don't hesitate to reach out to your accounting firm financial advisor or reach out to your TriCert Investment Counsel portfolio manager, or don't hesitate to reach out to myself. Take care.